Hey everyone, and welcome back to Gold Off the Charts. In a market full of noise, games, and uncertainty, we don't just watch the surface level hype, we dig into the real mechanics underneath. A little deep dive into finance every day helps you see further, walk steadier, and outlast the crowd on your journey to building wealth. I know many of you are feeling pretty overwhelmed right now. If you've been watching the charts over the last 48 hours, I bet your heart rate has been through the roof. We are witnessing an extreme market event that will go down in the history books of precious metals. Let's recap this wild 24-hour ride. Spot gold, which was recently looking strong above 5,000, suddenly felt like it lost its grip and was slammed down by an invisible force. From the high on February 4th to the low on February 5th, the price swung by nearly $300. Think about that. A $300 move used to be a whole year's worth of volatility. Now, it happened in a single day. As we record this, gold is catching its breath around 4,880, but the market is still clearly on edge. If you think gold was intense, silver has been like an extreme sport. Silver's drop was much more brutal, basically wiping out all its recent gains in one go. At its worst today, it was down a massive 18%, hovering around $76. This sharp reversal has left many traders who were feeling bullish yesterday starting to second-guess themselves. They're asking, well, what do we do? Should we get out now? Look, don't rush to any conclusions just yet. If this happened 2 weeks ago, I tell you it was a black swan, a rare freak event. But after the trial by fire we've had this past week, I have to be honest, this level of volatility might just be the new normal for a while. Look at the data. The Gold Volatility Index, GVZ, which measures fear in the gold market, is at a 5-year high. What does that tell us? It means the market is incredibly twitchy and capital is restless. For us precious metals traders, high volatility is now part of the daily grind. You need to get used to this rhythm and toughen up. Don't let short-term bumps mess with your head and ruin your long-term plan. Today, I'm not just here to help you navigate the chaos and explain why yesterday's rally was cut short overnight. More importantly, I'm going to reveal a warning that should make every investor sit up and take notice. Is this crash just a smoke bomb left by big players as they exit? Or is history repeating itself? Are we standing on the edge of a moment like 1933, which changed the fate of global wealth forever? By the end of this video, you'll see the truth behind the curtain. You'll understand if your shrinking portfolio is just a temporary dip, or if the world's elite have reached a silent agreement that a capital war has officially begun. First, let's solve one mystery. Why did gold's strong rebound suddenly lose steam? It comes down to two major forces at play. Let's look at the first factor, selling pressure from the East. This is a huge signal for market sentiment. According to Bloomberg, gold ETFs in China saw their biggest single-day outflow ever on Tuesday, nearly $10 billion. $10 billion. What does that say? It shows that as gold dropped from its highs, investor confidence took a major hit. The report noted that 4 major Chinese gold ETFs saw outflows for 2 straight days. The irony? Just last week, they hit record inflows. This is a classic case of retail investors chasing the high and panic selling the low. A few days ago, people were FOMOing in as prices soared. They followed the crowd to buy, but as soon as the crash started, panic set in, and they rushed to cut their losses. This panic selling directly weighed on gold during the Asian session, creating that first wave of downward pressure. But listen, while retail sentiment moves the needle short-term, it doesn't change the big picture. The real reason the market turned cold, and the true driver of this drop, comes down to 2 words: tightening liquidity. Have you noticed it's not just gold? Look at crypto, look at US tech stocks. Everything is sliding. Gold, Bitcoin, and tech stocks are very different assets, so why are they all being dumped at once? There's a clear logic. Tightening expectations lead to a leverage stampede, which triggers forced selling. The tide of cash is simply going out. Let's look closer at the triple threat causing this cash crunch. The first and most critical trigger is a sudden shift in expectations for the Federal Reserve. It all goes back to Trump's move, nominating Kevin Warsh as the next Fed chair. Who is Warsh? Wall Street knows him as the hawk of hawks. His main goal? Shrinking the Fed's balance sheet aggressively. He believes the Fed is too bloated and wants to slash the balance sheet from $6.6 trillion to under $5 trillion. Folks, that's a scary number. What was the market expecting? Most people were betting on rate cuts and easy money. Everyone thought the Fed would just print money to save the day if stocks fell, the famous Fed put. But Warsh's arrival shattered that dream. The market flipped instantly from easy money to rate cuts plus a shrinking balance sheet. This means the Fed is actively sucking dollars back in. The Fed is no longer the safety net for the market, it's becoming a strict debt collector. When cash gets pulled back, the money flow reverses. Smart money began exiting non-yielding assets like gold and risky ones like crypto or tech, moving instead into cash and U.S. treasuries. This pushed the U.S. dollar index higher, which puts even more pressure on everything else. That's why U.S. tech stocks took such a hit. We're seeing a sell-off in software spreading to semiconductors and AI. The Nasdaq dropped 1.51%. Big tech got hit the hardest. The semiconductor index fell 4.4%. And AMD tanked 17% after earnings its worst day in 8 years. Palantir dropped 12%, SanDisk fell nearly 16%, and even Google was down over 2% after hours. But there's something very strange here that you really need to think about. Are these tech stocks falling because they're doing a bad job? Not at all. Look at Alphabet Google. Their Q4 revenue was up 18%, hitting a record high. Even with AI spending up 42% and a one-time $2.1 billion legal payout, their profit margins were still over 30%. That is a massive money-making machine. Google Cloud beat expectations by 9%, and search revenue beat by 17%. With earnings that good, why did the stock still fall? This is a classic liquidity crisis. When people are desperate for cash, they don't sell what they want to sell, they sell what they can sell. That means selling high-quality, liquid, profitable assets. Tight liquidity forced people to sell, the price drop scared the market further, and money rotated into defensive spots like energy and materials. That's why the Dow stayed slightly up. Money is just moving to find a safe harbor. Now that we've analyzed the why, let's talk about what everyone is asking. What happens to gold next? First, let me give you some peace of mind. This drop caused by tight liquidity is a market environment issue, not a problem with the fundamentals of gold itself. In fact, as investors pull money out of risky AI and tech stocks, where do you think that money goes once the panic fades? It looks for safety. And is there a better safe haven than gold? In the long run, this exit from tech is actually good for gold. More importantly, we are entering a more chaotic, unpredictable era. The need for a hedge, a way to protect your money, isn't going away, it's actually growing. We're likely to see more black swan events. It reminds me of a specific moment in history, a period that looks a lot like today, 1933. Behind this gold rush is a warning every investor needs to hear. Soaring gold prices reflect deep cracks in the global economy, politics, and the money system. Right now, risky assets are still priced very high. Meanwhile, what are central banks doing? They are stockpiling gold and dumping US dollars. They are prepping for future trade wars and financial crises. For most of us, gold's reputation as a safe haven is rock solid. As long as you follow your local laws, it's seen as the ultimate hard currency. But if you know your history, you know there was a time in the US when regular people were forced to give up their gold. This was the Gold Reserve Act of 1933. Let's go back to April of that year. President Roosevelt signed Executive Order 6102. It was an incredibly aggressive move. It required every American to hand over their gold coins and bars to the bank by a certain date or face jail time. Back then, during the Great Depression, the dollar was fixed to gold at roughly $20 per ounce. Because the banks were failing, people panicked. Everyone tried to trade their paper money for gold, which drained the U.S. reserves. With no gold left, the Fed couldn't print more money to fix the economy. So, the government basically confiscated it. To make matters worse, the next year they raised the price of gold to $35. What does that mean? It allowed the government to print more money and devalued the dollar. It helped the U.S. economy recover, but it did so by stripping wealth away from the people who held gold. So, how is today like 1933? It's actually quite chilling. Today, we see countries becoming more protectionist, trade wars heating up, and global tensions rising. Central banks are loading up on gold and ditching US dollars for the exact same reason, to avoid being trapped in a financial crisis. Plus, as fiat, paper currency loses value, governments are essentially taxing your purchasing power through inflation. This makes gold's safety stand out again. History warns us that black swans are events you never see coming. I'm not saying the US will go door to door for gold again. Times have changed. But history shows that in a crisis, governments do extreme things. Look at World War I in 1913, the 1930s Depression, Nixon ending the gold standard in 1971, or the 2008 crash. These all show how much the government can interfere with the market. In an era of uncertainty, if a country declares an emergency, the old financial rules can vanish in an instant. As an investor, you have to realize that gold status can be shifted by policy and history. That's why we have to watch the big picture macro policies. To add to this, let's look at a recent warning from Wall Street legend and Bridgewater founder Ray Dalio. On February 3rd, Dalio spoke in Dubai. He said that with all the geopolitical tension and market swings, the world is on the brink of a capital war. What is that? Dalio says it's things like trade embargoes, blocking access to markets, or using debt as a weapon. This isn't just scaremongering. We aren't in a full-blown capital war yet, but we are very close to the edge. Fear can easily push the world into a conflict where money itself is the weapon. He specifically pointed to the Trump administration's talk regarding Greenland. That's not just politics, it's an escalation of tension. Reports suggested the administration threatened trade consequences if demands weren't met by Denmark. This included potential trade wars with Europe, or even military mentions. What happens then? Investors in Europe holding US dollars get scared. They ask, will my money be frozen? The US is also worried about losing European funding. Look at Citi's data. Last year, European investors made up 80% of foreign US Treasury buys. If that stops, the US bond market is in big trouble. Dalio says capital and money are the lifeblood. We're already seeing capital controls around the world, and central banks are preparing for them. This mutual fear is making a capital war more likely. Dalio noted these controls are happening globally. He emphasized, we are on the edge. It doesn't mean we're in it yet, but it's a very real concern. He used history to warn us. Before World War II, the U.S. sanctioned Japan and froze their assets, which turned a dispute into a full-scale war. Dalio says we could see something similar today, as leaders discuss how much the U.S. and Europe rely on each other. A trade deficit is just the flip side of capital. These imbalances can be used as tools for conflict. Historically, these wars involve strict control over how money moves. Trump's tariff policies have only added more fuel to the fire. Since returning to office, he's used tariffs as both a punishment and a political tool. Even if he walks some of them back, the unpredictability creates massive swings and hurts market confidence, making people worry about financial weaponization. In this mess, what is Dalio's advice? Even with the recent gold crash, he's still standing by it. He insists gold is still the best place to keep your money. He says, you can't judge it by the day. When asked if the crash makes gold unsafe, he pointed out gold is still up 65% from a year ago and only down 16% from its peak. Don't obsess over daily swings, look at the trend. Dalio suggests that central banks and big funds should keep a portion of their money in gold. Why? Because it's a great diversifier. It protects you when other parts of your portfolio are failing. It shines during the bad times, even if it's boring during the good times. It's an insurance policy. So when you connect the dots, the underlying reason is clear. Short term, we have panic selling in China and fear of tight money from the new Fed nominee. That's why gold and silver pulled back. The tech sell-off proves that cash is tight right now. But if you zoom out, we are in an era like 1933. We are on the edge of what Dalio calls a war on capital. With the risk of currencies being used as weapons and potential capital controls, gold, the only hard asset without government risk, is more valuable than ever. These short-term drops are just the tide going out. The long-term rise is because people are losing faith in the system. So I have a few final thoughts for the community. Understand the nature of the drop. This was a cash crunch stampede, not a failure of gold itself. When the forced selling stops, the real buyers will return. Don't follow the herd. The record outflows in China show that retail traders are panicking. In investing, when the crowd runs for the exit, it's usually time to stay calm. Get used to the new normal. The volatility index tells us the ride will stay bumpy. Adjust your position size to fit your stress level and avoid high leverage right now. Focus on long-term value. Like Dalio says, gold is about protection. Don't sweat the daily balance on your screen. Focus on its role as a shield in a crisis. Finally, I want to hear from you. What do you make of this two-day crash? Do you think this is just a dip before a bigger rally? Or is the bull market over? With Dalio's capital war warning in mind, are you buying more gold or are you taking your profits and leaving? Let me know your thoughts in the comments. In these uncertain times, our community's insights are worth more than gold itself. Just a reminder, this analysis is my personal view and reasoning, not official financial advice.
Investing is about what you know and how you manage risk. The market is unpredictable, so always think for yourself and make your own choices.
If this video helped you make sense of the market today, please give it a like and subscribe. Share this with any friends who are feeling lost in the markets right now. This is Gold Off the Charts. See you in the next one.